Hey, welcome back to another video on the channel. Today I'm going to talk about the Federal Reserve, what it is, how it relates to, and what it does. So first, let's talk about what the Federal Reserve is. And you might have also heard this called the Fed, but it's the central bank of the United States. And it has a few roles that we're going to talk about in detail a little bit more later, but it essentially manages the economic condition of the US. So the Federal Reserve was established in 1913, and it was a response to financial crises and economic issues. And its goal was to provide a more stable banking system with different regulations and rules that it sets and abides by. Let's talk about a few terms associated with the Fed first. First is the Fed funds rate, which I'm going to discuss this later, but it is the exchange rate, the interest rate between banks. Now, there's obviously varying interest rates when you interact with the bank, but there are set interest rates when banks interact with each other or when they interact with the Federal Reserve. That's called the Fed funds rate. Monetary policy, as far as it's concerned in day to day life, is essentially just actions taken by the Fed, whether that be buying bonds or selling bonds, bonds being something that we covered in a previous video. And those are two of the main terms that you're going to need to understand what the Fed does. Speaking of understanding what the Fed does, let's talk about exactly what it does. Now, the Federal Reserve works to keep inflation at around 2% by adjusting monetary policy, which is, again, the government buying and selling bonds, and it tries to monitor price changes in the economy. This may seem weird to many of you, but inflation can actually be a good thing. The ideal inflation rate is about 2%, and that's what the Federal Reserve tries to keep it at. Another thing the Federal Reserve tries to do is to promote employment. Now, the Federal Reserve tries to create economic conditions where as many jobs exist as possible and people can get those jobs. However, like inflation, there is an ideal unemployment rate as well, which is about 4.5%. The Federal Reserve tries to keep unemployment in that threshold for the most part. Since the Federal Reserve was created in time of economic crisis, one of its main functions is to stabilize our economy. And the way it does that is by intervening during financial emergencies and supplying funds where needed or enacting policies where needed. Some examples of where needed can be the 2008 crisis or the pandemic that recently occurred. Now, one of the last things is setting interest rates. Now, again, as I said, there are varying interest rates when you interact with a bank. So the Federal Reserve doesn't really set interest rates. What it does is it determines the Fed funds rate, which is, as I said, the interest rate between banks. Now, this may not seem that relevant, but the interest rate between banks influences the interest rate for your loans, the interest rate for businesses, and the interest rate for most economic activities. This affects how much people spend versus how much they save. Let's move on to how all of these effects actually impact you. So, since one of the main things that the Federal Reserve does is impact interest rates, let's talk about what high and low interest rates can do to you. First, high interest rates. High interest rates can make borrowing more expensive, so people spend less. People being both you and I, and just spending less in the economy as a whole. Low interest rates have the opposite, since it's cheaper to spend and borrow, and since when you save money you get less than high interest rates, people want to spend more. This can help creating low interest rates can help stimulate the economy in times of need. Lastly, let's talk about relevance to you in just overall. High interest rates can mean more expensive car loans and college loans, but can also mean more money when you save. Whereas low interest rates can mean it's easier to borrow money for different loans and things are cheaper, but you get less money if you just put it in the bank. But all of these are just decisions that the Federal Reserve can make. Let's talk about how they actually make these decisions, on the other hand. So first, there are 12 regional banks that operate across the US in the Federal Reserve System. These banks gather data and information, and they provide insight into how their region is economically. Fun fact, while these 12 banks are scattered across the country, Missouri is the only state to have two of them. Every every other area is at least is one. Sorry about that. Now, the Federal Open Market Committee, or FOMC, is the committee that actually sets key interest rates and guides monetary policy. This is the committee of people in the Federal Reserve. They meet about 8 times a year for a few purposes. One is to analyze economic indicators, but another very important one and very relevant one is to publish what is called the Beige Book. So this Beige Book, like the meetings, is published 8 times a year, and it shows an economic snapshot of each of the 12 different Federal Reserve districts. It can show current economic conditions like consumer spending, labor markets, business conditions, and much more. The Beige Book is available for any citizen or any person to read. Now, lastly, the Federal Reserve's main job is to make decisions. Now, they make those decisions with data analysis that is covered by each of the banks in the Federal Reserve in each district, and just general knowledge like unemployment rates, inflation, and consumer spending trends. All of this helps the Fed predict economic conditions and adjust their policies accordingly. Now, I don't have a specific slide for this, but I want to talk about this because I think it's a very misunderstood part about the Federal Reserve, which I'm about to talk about misconceptions, but I think this is more important. So, if you're going to take any notes or take anything away from this, I'd say take it away here. The Federal Reserve's main power is the ability to talk. It's not any certain book that they can publish. It's not any certain policy they can enact. It's the ability to talk to and communicate with the people about predictions, expectations, and goals for the economic situation of this nation. Now that I've gotten that major misconception aside, let's talk about some smaller and more common ones. So the Federal Reserve can be confused with some government branches, but it does not print money. That is what the US Treasury does. Now, the US Treasury is often confused with the Federal Reserve in a variety of ways. So let's talk about the Treasury for just a second. Now, the US Treasury issues currency and manages government accounts, whereas the Federal Reserve regulates monetary policy. These sound similar, but you have to remember that these are two very distinct things. The Federal Reserve is its own separate government-owned entity, whereas the US Treasury is a branch of the government itself. However, both of these can help maintain overall economic stability in the nation. Lastly, I want to talk about the invisible influence on the economy. I think a lot of the things with the Federal Reserve is what you can see, especially since their power is to talk to the people. But the Federal Reserve decisions are slow, right? Nothing is at the drop of a hat like a lot of politics seems to be. Instead, actions on interest rates, inflation, employment, all of that is incredibly slow and takes time and due process. So you're not going to see any crazy news about that more often than not, but the Federal Reserve is working in order to keep the nation economically stable. That's everything about the Federal Reserve. If you take away nothing else, just know that it is a institution owned by the government that can talk to the people about the economic condition of the nation and can analyze and make some decisions. Thank you for watching. Make sure to like, comment, and subscribe.